This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Okay, so let's go through and have a look at another example with regards to prior year errors. This one is a lot more straightforward than the one that we went through and looked at previously, and it's beginning to reflect what you're likely to see now within this financial reporting exam. So let's go through and have a look at what it's about. The scenario wants us to go through there and explain the accounting treatment within the financial statements of this company, Dodgy. So yes, I know within financial reporting you're not going to have to explain anything, but we'll explain it so that you can then use that within a longer, say, published company account style question. And then that application will then work for any financial reporting style question going into the exam. So yeah, we're going to focus on the explanation. The financial statements, again, when you're thinking about the financial statements, particularly with published company accounts, we normally think SFP. We normally think statement of profit or loss, but when you're looking at published company accounts, you also can see within the statement of changes in equity. Now, that's always quite relevant for when you have a question revolving around prior year errors. Because when you think about your prior year errors, you have to go back and retrospectively adjust your financial statements, with the adjustment being to your brought forward retained earnings through the statement of changes in equity. So within a question, if you're asked to prepare a statement of changes in equity, it only again ever tends to be for 4 or 5 marks. One of those marks at least is going to be for that prior year error. So what have we got within the scenario? We're told there's fraudulent financial reporting, so therefore we need to go back and adjust for that fraud, which amounts, is it there, to $3.4 million worth. That's in relation to your receivables. So that is saying there that they then need to be written off. So they need to be removed from the accounts, don't they? So we need to reduce the receivables by the 3.4 million. So effectively, if you like your debits and credits, which I know you do, don't lie, we're reducing the receivables. So we're crediting the receivables. Whereabouts does the debit entry go? You've got to be careful. You've got to read the question carefully, because what you've got there is that 1 million is in relation to the current reporting period, and the remaining 2.4 relates to the previous period. So effectively, this 2.4 from the previous period, that's the prior year error. So that is what will need to be adjusted retrospectively. The 1 million in relation to the current period just gets adjusted this year through the statement of profit or loss. The prior year error is adjusted through your retained earnings brought forward within the statement of changes in equity. So should we just go through and explain that in a little bit more detail, so you've got something to look at and to think about? So we had, was it $3.4 million worth of receivables? That was an error. That needs to be adjusted. Of that 3.4 million, it's split into 2 parts, isn't it? 1 million relates to the current year. And then is it the remainder? The 2.4 million relates to the prior year. Okay. So if you're going through and doing an exam question, get the current year right first. Yes, I know the question is testing you on IAS 8 and prior period errors, but here you've just got a write-off of a trade receivable. So within the current year, all you're going to go through and do there is reduce the receivables by, is it there, the 1 million. So that's on the SFP. And you're also going to go through there and increase the expenses through the statement of profit or loss. Okay. If you want journal entries, I suppose you're crediting your receivables and debiting the expense. And that expense is likely to go through your admin expenses, okay? Your operating expenses. Do not put it through cost of sales. It is not a cost of selling the goods. It is a cost that arises after the sale of the goods, isn't it? So it's part of your operating expenses. So that's the really straightforward bit. There is still a little bit more of a straightforward bit in relation to the 2.4 million. I know we say it's a prior year error, but you know there's still 2.4 million worth of receivables that needs to be written off. So again, you're going to reduce the receivables on the statement of financial position. So again, that's a credit to your receivables. That's a credit in the current year. You're adjusting the SFP. So effectively what you're doing is you're crediting your receivables in total with 3.4 million, aren't we? You've debited your expenses with the 1 million. So what about the remaining debit of 2.4 million? Well, what we're going to go through and do that is we're going to reduce the retained earnings brought forward by the 2.4 million on the statement of changes in equity. So effectively what we're doing there is you are debiting your opening retained earnings. Be careful where you do that. That's in the statement of changes in equity. I can hear you saying, well, Chris, where do I do that within the statement of changes in equity? How does it look? Well, let me show you. So what you've got there is we have the statement of changes in equity. I'm just going to do it as an extract from the financial statements. I'm not going to do the full statement of change in equity, so I'm going to ignore all that share capital, share premium, revaluation surplus nonsense that you may get within a question. We're just going to focus on the retained earnings column. And what you're going to have is you're going to have your brought forward that was previously reported. So that figure you get from the question, and that will be in the TB, isn't it? Okay, that would be the trial balance retained earnings figure. What you've then got is you've got your error. And again, what I'm going to do is, like you see in most exam questions, you work in round thousands. So we've got our error, which is an adjustment to your retained earnings. Is that at 2.4 million, 2,400. So that there is effectively what we're doing here. The debit to the retained earnings in the statement of change in equity for that 2.4 million pounds. Did I say pounds? Dollars. Okay. That then goes through there and gives you your carry forward. So your restated retained earnings. And then what you've got, you know, if you were to finish off the question within the real exam, you'd have your profit for the year. So again, that profit for the year comes from the statement of profit or loss. That's the easy marks that you can get because you just use your own figure. And whatever figure you have from profit for the year from the other part of the question, you just transfer that to the statement of changes in equity. If you don't do that, that's your own fault and you're going to lose marks within the exam. You don't want to be losing straightforward marks. Don't forget that you've got your dividends, which is a reduction to your retained earnings. And then that will go through there and give you your carry forward. Okay. Again, the dividends will be given to you somewhere within the question. It might be contained within the TB, in which case just take it straight from there. It could very well be that you might have to calculate them based on the number of shares in issue and the dividend declared per share. I don't know. Examiner can do what they want, can't they? But the typical marks that you're going to get are looking at the opening figure on the TB. So that should be easy. You've got the error. That's a little bit challenging, isn't it? Because you want to adjust it for 2.4 and not the $3.4 million. And again, there's another easy mark within there, isn't there? With regards to the profit for the year figure, your profit after tax, if you like to still call it that, from the statement of profit or loss. There we go. Excellent. So that's looking at what I would say is a more exam standard, exam style question, as opposed to slightly more complicated, long-winded example that we did earlier. Work it through, make sure you understand it, have a go at the questions within your study text or revision kit of your chosen tuition provider, and you can't go too far wrong then in any exams.